Well, welcome everybody. Welcome everybody. Welcome to another Tactical Tuesday. Well, my goodness, I am excited for tonight. I think there is a big change happening, right? We know this. There's a big change happening across the country. Let me know where you're from. I'm going to say this is the first time in my 25 years of being across the country, because we have been across the country in all the different real estate rooms for the duration up since 2003. And I think this is the first time ever that I can say that there is massive shifts in every market and that every market is sitting in kind of this like null point. So I wanted to talk tonight about that null point. What happens when markets change? Because lots of us think this means like stop, there's no opportunity, everything crashes, we got to just fire sale. I wanted to share with you a case study tonight. And I love it. The numbers are so powerful. And the strategies are simple. And so I really hope that this inspires you to really think about not just giving up and giving in when things get tough, because there's always a way. We just got to kind of think about it. And then, of course, know the tools to use for it. So I'm just going to confirm that I have comments coming. Whoa, sure do. There we go. All right. So let me know where you guys are from Cochrane. Joan, talk about markets changing, right? When you are in an Alberta market, as long as you've been, we get used to change. But there's a shift going on even in a good way in Alberta, but it's kind of a little bit of a who knows what to do. So tonight we're talking about VTBs, vendor takebacks. We're talking about pivots. We're talking about agreements for sale. We're talking about all kinds, three different scenarios in one deal that had to come together. More scenarios, more transaction engineering that could have happened on this deal and creative strategies that could have happened on this deal. But it's awesome when you can take a normal deal, walk it through, and actually change the outcome of it when your first plan doesn't work. And then when your second plan doesn't work, and come out with something that does work. So, name of the game is pivot. We know that as investors. So, here we go. Where else are we from? I think comments are a little bit slow in here. So actually, yeah. And if you don't mind throwing comments in the chat for me so that I can keep up on it, because it is kind of stalling. I don't know why I can't get all three things working every single time. Seems that it's here and there, but yeah. Okay, thanks, Ange. You got that? Okay, guys, so I'm going to just share my screen here. I'm interested to know how many of you guys have done a VTB. And how many of you guys have done an AFS? And those of you that are on the replay, still type it in. Let me know what you're saying. Dawn from Cancun, Mexico. Oh, I was just gonna say, oh, I'm jealous. Well, I am jealous, actually. But how many of you guys have done a VTB? And just type in VTB. And how many of you done an AFS? And how many of you have heard of these things? Haven't done them, but would like to. And I think tonight is the night about creative strategy for sure. Okay. So I'm just going to share my screen and we're going to run through. This is something that we taught in our Out of the Box series that we did with Barry McGuire. So Investor Life and Bear McGuire and Donna, we joined forces back a couple years ago, and we ended up doing this whole series on creative financing structures. And so this is one of the case studies from that day that we did. So maybe you guys were there, maybe you will remember. Oh, Robin did one. Nice. On a business. Okay. And oh, Lucho, hi, Salgado, nice to see you. Yeah, so these things are often in business and often in commercial real estate. These VTBs, vendor take back mortgage, which is just a seller financing avenue. But it's amazing how powerful they are. They were really instrumental in my buying. When Corey and I bought all our properties, we often did a VTB. And that really helps you to be able to put less money down on a property, less down payment, therefore more ROI, right? All right. Oh, Robin, a VTB on a house lately too. Nice. Nice, Robin. And you said that you've done a couple of offers, but actually haven't had one accepted. Okay. So I'm just gonna share my screen. I'm gonna go find first here we go. All right, now let me see if I can. It's being a little bit finicky here. I was trying it earlier and it didn't work every single time the same way, so we'll see how it's working right now. And we'll go here. Oh. Okay, let me know if you can see my slides. And I may not even be able to see your answer. Okay. Oh no, now I can. Yeah. Okay. Got it worked out. Okay. Okay, so we've got what we're talking about tonight is again out of the box thinking, right? We want to think creatively, we want to think out of the box, we want to think how can I engineer this transaction or this deal into working, especially when there's a market shift, especially when things don't go according to plan. So here's the story. This is a property that it was basically going to be a super easy flip kind of thing. It was going to be some forced appreciation. They were going to put in a suite in the basement, sell it, create a $60,000 profit. Brilliant, right? Super happy. Things didn't work out that way. They went from expecting a $60,000 profit down to expecting a $12,000 profit. Pretty brutal, right? Not great. Better than nothing. They could have walked away at that, but instead they turn. Oh, you just see a blue screen. Okay, good to know. Hang on. How is this one then? Nope. Is that the blue screen that you're seeing? Hang on. Hang on. Now do you see a slideshow? All right. You're gonna have to text me on WhatsApp, guys. Sorry, I cannot see. Yes? Okay, I see your thumbs up. Thank you. I do not see the comments in Zoom. I don't know. Anyways, okay, this is what we're talking about right here. So let me know in WhatsApp and Nin and Rebecca if you can. Okay, thank you. We're looking at your desktop and now you see it. Thank you. Okay, so $12,000 flop of a deal. I mean, it's still 12,000 bucks, but it's certainly not the 60,000 that they planned on. At the end of the story, you're going to see how they turn it into an $82,000 win. Okay. And you have to get creative and you have to pivot. So let's hit through some of these. Okay. So this investor had a social media post out there. Again, one lesson here, importance of getting out there and letting people know what you're doing. Someone contacted them and said, hey, listen, I got to sell my house and I got to sell it fast. I need out right now. So when you have that motivated seller, you have often terms that you can play with. So not just money, but terms. So in this case, this guy needed out. So a vendor take back mortgage was put in place. And the guy needed $30,000. Okay. He had $250,000 in equity in his home that could have been but he didn't want to utilize it. He didn't want to do all the work. He didn't want to use all of that stuff. So he sold his place for $240,000. Didn't want to put in a suite himself. Sold it for $240,000 to our investor A. Okay. The down payment on that was $30,000, and the rest was held. So our investor A did not go to a bank and get a mortgage on that. The rest was held by the seller of that property at a 3% interest rate. 3%. Okay. That's pretty good. That's better than what we're seeing right now from the banks. So great win. We've got somebody holding a mortgage for us. Investor A doesn't have to qualify on this property. This is a great win. It gives them time to put in a suite. Okay, so the plans, this was again, plan A. We ended up in plan C that it actually ended at, but plan A was to buy it for $240. Holding costs and rental costs were going to be about another $130,000. Sell it for $440 or $445, whatever it was, kind of a range. Expected profit would be around $60,000. After repaired value, shows up around $450. This is good stuff. Easy peasy. They probably have done a few of these. I know I have. So this is the plan. And somehow it just does not work out that way all the time, does it? So let me just check what's up. Sorry. How are we doing, guys? You're good? Okay. I'm just checking the Tactical Tuesday chat, guys. Are you seeing the slideshow with the full screen, or are you seeing my desktop that has presentation mode? Yeah, okay. I don't know why this is coming on over here and that is coming on over there. It's because I have two screens and I'm not sure how to get that over there. Hang on. I'm going to stop share for 1 sec. I'm not good at technology. Let's see what we can do. You know what? Actually, Rebecca, can you play, or Nin, sorry, can you play the explainer video? Why don't we do that while I play with this? So this is just a video, kind of explains how the deal ran through, what it looked like, and then we'll break down the numbers after. Yeah, you're seeing PowerPoint. Okay. It is on full screen on my one screen, just not on the other. So I think I have to turn off double screen. So, all right. And just share the sound on there.
Okay, so what happens when what you think is the perfect real estate deal just completely falls apart? Today, we're going to dive into a case study where a pretty simple property flip went totally sideways. But stick around, because a super clever pivot didn't just save the deal, it actually made it way more profitable than the original plan. Pretty simple property flip went it's totally pretty much sideways. An investor's worst nightmare, right? You've done all your homework, the numbers look solid, and then it all just starts to crumble. So what's the move? Let's break down exactly how one investor navigated this very situation. All right, so our story starts with what looks like a textbook slam dunk property flip. On the surface, every single piece of this puzzle seemed to fit together perfectly. The setup was just ideal. You had a motivated seller who needed to get out quick. Our investor was able to scoop up the property with a pretty small down payment, and they used what's called a vendor take-back mortgage, which is just a fancy way of saying the seller themselves helped finance the deal. The plan from there? Super simple. Add a 2-bedroom suite to pump up the value, and then sell it for a nice, clean profit. Easy peasy. And the numbers looked fantastic. A purchase price of $240,000 with a budget of $130,000 for all the renovations and holding costs. The target sale price they were aiming for, a very solid $450,000. On paper, this was a guaranteed home run. And that home run translated to a projected $60,000 profit. That's a really healthy return on investment, right? More than enough to justify all the work. So at this point, everything is chugging along smoothly, exactly according to plan. But as anyone in real estate will tell you, the market has a mind of its own. And just as the renovations were wrapping up, the ground really started to shift under the investors' feet. And it wasn't just one problem. It was a double whammy that hit at the exact same time. First, on the inside, the finishing work on the reno, the stuff a buyer really looks at, just wasn't up to snuff. And then on the outside, the entire real estate market took a sudden, unexpected nosedive. What a brutal combination. And the impact was just devastating. That expected sale price of $450, poof, gone. The new reality was their realtor told them they'd be lucky to get $400,000. And this absolutely crushed the profit, dropping it from that healthy $60,000 all the way down to just $12,000. I mean, imagine all that work and risk for practically nothing. So this is the turning point. This is where most people might just take the tiny profit and run. But instead of accepting that, the investor decided to get creative and pivot to a completely new strategy. And this new strategy? It all revolved around something called an agreement for sale, or AFS for short. Now, in simple terms, this is where our investor, the seller, basically becomes the bank for a new buyer. The new buyer makes their mortgage payments directly to the investor, and the actual title to the property only transfers over once the whole agreement is paid off, usually in a few years. So the solution was a really clear three-step process. First, our investor refinanced the property to pull their own initial cash back out. Second, they went and found a new buyer, specifically one who couldn't get a traditional mortgage from a bank. And third, they structured the whole thing as one of these agreement for sale deals. Now this is where it gets really, really smart. The AFS wasn't just a way to save the deal for the original investor. It actually created a total win-win situation that was also incredibly beneficial for the new buyer. So here's what the new deal looked like. The sale price was set at $440,000. Hey, that's much closer to the original target. The new buyer put down $40,000, and our investor financed the remaining $400,000 for them over a 3-year term. So for our original investor, the seller in this new deal, the benefits were huge. They got the price they wanted. Between their refinance and the new buyer's down payment, they pulled all of their own cash out of the deal, so they're not at risk anymore. They even created $350 in passive monthly cash flow for themselves, and their profit was now locked in, just waiting for them in 3 years. And what about the new buyer? Well, this was a massive opportunity for them. They got control of a cash-flowing rental property without having to qualify at a bank. The property immediately started making them $500 a month in positive cash flow. Plus, they're building equity with every single payment, and they have a clear 3-year runway to improve their credit and eventually get their own mortgage to take full ownership. It's a game changer for them. So, the big question. After all this creative maneuvering and problem solving, what did the final numbers actually look like? Did our investor just manage to break even, or did this whole pivot actually pay off? Let's break it down. The gross profit was $200,000. After you subtract the $130,000 in costs, the net profit was $70,000. But don't forget that monthly cash flow. Over 36 months, that added another $12,600, bringing the grand total profit to an impressive $82,600. $82,600. By pivoting to a creative solution instead of just taking the loss, the investor didn't just save the deal. They ended up making over $22,000 more than their original perfect plan was supposed to. Absolutely incredible. It really makes you think, doesn't it? Is a so-called problem property just a setback? Or is it secretly an opportunity in disguise? It seems that with the right creative strategy, your biggest challenge could actually turn into your most profitable win.
All right. Cool, hey? Isn't it cool what you can do with AI? So putting my presentation into AI, it spit out the exact scenario that we're talking about tonight. So we're going to start this again because I was not sharing properly. I think I've got it good now. So for those of you that have just hopped on, have you done an AFS? Have you done a BTB? Do we know what these things are? Do we want to? We want to, because at the end of the day, these are some of the creative strategies that can take a deal from being an okay deal to being something completely a massive win for us. So yeah, that was like, yeah, crazy, hey? All right. Should we go through numbers? Was that a little quick? Thumbs up if that was a little bit quick for you. And we want to actually break down numbers. So that's what we're going to do now. We're going to break down numbers here. Okay. All right. So let's see how this goes. And thank you, Nin, for sharing that video. Good job. All right. Let's see if we can get rid of this. And how we doing? Does this look a little bit better than it did the last time we tried this? A little quick, so breakdown would be awesome. Yeah. Okay. So again, we're going to go from the top because I didn't have, can you see my screen? Let me know if you can see my screen. A little afraid to get out of this. Yes, thank you. Okay, good job. Thanks, guys. Man, what would I do without a team, hey? Okay, out of the box thinking, that's what we want to do. That's what takes deals that could be dead deals to deals that can actually work. And the more of an unstable market you're in, the more you're going to need to think creatively. So we do have one of the biggest creative thinkers that I've ever met, that back when we started in real estate, he was rolling. He was at like 400 doors, single family doors, and has gone through the gamut. And he's going to come on Tactical Tuesday here in the next few weeks. We don't have a date nailed down yet, but to break down what, these kind of how we start thinking, how we learn these strategies. So, okay. So $12,000, fine, but we'd like to see it a lot more. This deal turned into an $82,000 win instead. And here's how. First of all, their first plan, okay, their plan number one, social media. Someone told them that they, did social media. They were posting regularly, right? Good lesson for us. And they contacted them and said, hey, listen, I have a house for sale and I need out of it right away. So they established a purchase price of $240,000. Now, the investor knew that by putting in a suite, they could force that appreciation up and sell it for way more. But this guy wanted out fast, so terms were able to be dealt with. So the purchase price was $240,000 that our investor A bought it for. Down payment of that was only $30,000. Lots of times, like obviously this guy had equity in the property, but he just needed 30 grand for whatever reason. For that reason, our investor A was able to put down 30 grand. The rest, our seller carried as a VTB, or a vendor take back mortgage. We're going to be seeing a lot of these happening here. We're already seeing it, but it was a key strategy in the early 2000s and mid 2000s. It's going to be coming back in a big way. I can already see it, and all the deals I can see where I'm like, "Ooh, yes." For a while there, it wasn't really powerful, but as always, things cycle, right? So they paid. They did not have to go to the bank. Investor A did not have to go to the bank. They just had the seller carry financing for them. So a title change happened. Okay, that's keynote in a vendor take back. A title change happens. Investor A now becomes the owner, and the seller holds a mortgage for them. And they were able to negotiate a great interest rate at 3%. You often can when you have a motivated seller. All right, if you have any questions, throw it in the chat. Okay, we're good there. I will be pausing a little bit to catch up on any questions if we have any. Okay, so this was the plan. They bought this place for $240,000. They planned on adding a suite. Notice the suite and holding costs were $130,000. It's not $50,000 put in a suite. It is, generally speaking, in most markets, count on $100,000. Okay, plus your holding costs and all those things that you have to count on. Utilities, someone to clear the snow if you're not doing it. All these things, all these little things add up. So holding costs and renovation, forcing that appreciation up by putting in a 2-bedroom suite, $130,000. At the end of the day, when this investor A was going to sell this place, it would be $60,000 profit. Okay, not bad. Sounds good. They hired a contractor to do this work. So they weren't even doing this work themselves. They were using key team members to do this stuff. Sounds great. However, the market changed. So we know that a renovation can take a little while. We also know that markets can change super quick. So within a few month period, a couple of things happened. For one, the contractor that they hired did a less than perfect job. Foundationally, it was okay, but the finishing touches were not great. Maybe ugly, could even call it. And like the slide says, it's the finishing touches that the buyer sees. And so they knew they were not going to be able to sell this property for what they had anticipated, even if the market hadn't changed. But the market did change. So things went down, wasn't great. They now were thinking they were going to be able to sell in the 400-ish range-ish. So again, from about 450-ish, they thought they could sell it for, down to 400. Their profit just completely evaporated. So now they're looking at about a $10,000 profit from a $60,000 profit. Not quite as exciting, right? So what do we do as investors, guys? We could sell and we could say, okay, well, I guess it sucks and it wasn't a great thing and I wasted all my time and my energy and blah, blah. Or we can transaction engineer, okay? Again, for those of you in markets that are shifting, for most of Canada right now, we are going to be seeing these VTBs coming back in a big way. I'm sure of it. I'm seeing it already. I'm feeling it. For a long time, they didn't make sense. They're making sense again. So we're going to start having to use these things. If you have questions, throw it in the chat. Okay. Quite the drop, right? Hey, Corey. Corrine. Okay. So here's the first pivot that our investor A had to take. Remember, we ended up with scenario 3. A, B, and C, plan A, B, and C. He ended up at C. Again, this is from our out-of-the-box strategies course that we did with Barry and Don McGuire. Fantastic information. We did a one-day thing back a few years ago now. This is one of the case studies from that. Okay, so the first pivot that our investor A took, and the reason I'm saying investor A is because you're going to see at the end of the story, there is another investor that gets involved, and that's investor B. So first pivot is the plan was to sell, okay? That was no longer happening unless he wanted to take a $12,000 profit, which was not ideal. So instead, decided to wait. I guess I'm not getting out of this one so early. I'm going to refinance it because remember, he's got a vendor take back with the seller that he needs to pay that back. It's like a mortgage that this guy is holding for him. And this guy probably had a deal, you know, for a year or under. You hold this money for a year or under. I'll fix it up. I'll put a suite in it. When I sell it, I'll pay you back. That wasn't happening anymore because again, the equity had completely evaporated, right? Hey, Mike. Hey. So these things had evaporated. We got to go to a different plan. We got to pay this guy back. What are we going to do? So he goes to the bank, conventional finance or financing, normal financing, gets a refinance. Again, he has pushed the value up, right? He has done a suite that does up the value. Banks don't look at finishings, thank goodness. So he's now like, okay, I guess I'm just going to refinance this thing and I'm going to hold on to it until the market shifts, whatever it might be. Okay. It's okay. It was cash flowing. Not a bad thing. Another lesson we can take from this. If you're going to do a flip or a short term in and out of the market, always make sure that if you had to hold it, it still cash flows. So yeah, we can go in and buy a place and we can flip it when the market's going up and everything goes well. We're laughing, great. But many times, guys, many times, especially on our first few flips while we're learning the game, we have to keep these properties. And so that really sucks if you're down $300 or $500 or $800 a month. So another lesson we can learn from tonight, if you're going to do a flip, make sure that it's going to cash flow if you got stuck with it. So that's what we see here is this, person got stuck with it. Okay. So they're okay with that. This is an okay plan. I'm holding out. However, here is the second pivot. Sorry, I just got to get rid of this. There we go. Go back. All right. So here's the second pivot. They now go to another investor. Okay, so we've got investor B. They go to this other investor and they say, this investor says, hey, I want to buy a property. I can't qualify in a mortgage. It's just not happening for me, not for a while. Investor A says, well, I have a property that I'm not really keen on holding. I was wanting to get rid of it anyway. It's a good property. It will cash flow for you. Why don't I do an agreement for sale with you? So I will agree to sell it to you later. Okay. Keynote here is that the title stays in investor A's name. Okay. Key difference, stays in investor A's name. But the control and the interest and everything that goes on with that property, for good or for bad, goes with investor B. Okay, do we got that difference? Making sense, everyone? I want to see some thumbs ups. Thumbs ups. If I'm making sense. I'm gonna pause in right after this slide. So investor B, thank you. Okay, investor B cannot qualify for a mortgage, but he's got some cash and he wants to get it to work and he wants to buy a property. So they make this deal. We have an agreement for sale. In 3 years, you will buy this property from me. In the meantime, you're going to give me your 40 grand as a down payment. You're going to take over control. You're going to take over ownership. You're going to rent it out. You're going to keep it maintained. If the property goes up further than what we agreed on, you get to keep that equity. If it doesn't, you lose that equity. It is now on you. They're responsible for, they get the beneficial interest of that property, even though title remains in investor A's name. Is this making sense? Awesome. Thank you, guys. Thank you. Thank you. Clear as mud, right? Okay. So this comes about, again, I want to just remind you, by thinking outside of the box. We could have left it here and said, plan B is to refinance and hold it until the market goes up and we can sell it for what we wanted, because we don't want 12 grand out of it. We want 60 grand out of it. When it gets to that, we'll sell it. Or you meet someone who has a problem that you can fix. In this case, another investor can't qualify on a mortgage, but wants to buy a property, has some money. So now what has happened for us is we have refinanced and gotten all our money back out of it anyway. Now we have a $40,000 down payment. So our ROI is growing by the minute, right? Awesome. Thank you for all the thumbs ups. That's awesome. Okay, I'm going to stop sharing and see if anyone has any questions. You let me know if you have any questions. I'll just give you a minute. I know we have a small group on again tonight. That's just the way it is lately, isn't it? Yeah, Facebook is just not our friend. It's not our friend, doesn't want to be our friend. That's okay. We might be changing this up, you know? We might be changing this up. We'll see how this all goes. But I'm just going to pause here. Let me know if you have any questions. If not, we will continue on. So far, we've talked about a buy, which would going to be, you know, a push of appreciation up into a sell that came in with a VTB, is now turned into an AFS, an agreement for sale. No questions? I'm going to keep going. Man, things are so different, hey? Maybe you guys all know this stuff. Used to be that it was like, oh, we have so many questions, we can't keep up on it. Okay, I'm going to hit. You let me know if you're seeing what we need to be seeing. Okay. Okay. So here we go. Here's the agreement for sale part, okay? They've agreed on a purchase price of $440,000. That's right back up there with what they'd wanted before, right? They wanted $450,000. So it's not quite what they wanted, but they're going to make up for it. Just watch. They've got $40,000 more in their pockets. So they're almost paid. All of their initial capital is almost now paid back from that refinance, right? The VTB has been paid out. They're done. New price is $440,000. They have 36-month agreement, 3-year agreement. And the seller, in this case, the seller is now investor A. And the seller now is the bank for investor B, who will buy it from him in 3 years. All right. Yeah, this is just kind of a little breakdown how it all works. One thing I want to point out here is the cash flow. Oh, sorry. the cash flow spread. So the buyer has now taken over the payments, right? So investor B is taking over the payments. The agreement for sale has a spread on interest rate. So investor A might be paying, let's say the banks are charging him, because remember, he got a refinance. So the banks are charging him 4.5% right now. He's charging investor B 6%, 6.5% maybe. So he's got a spread on the interest rate. He's creating income from that spread. Investor B is now renting out this property. Remember, it's got two units in it, and he's bought it for $400,000. He's now renting it out. He's able to cash flow $500 a month. We've got two investors now cash flowing on the same house in different ways. Now we might say, oh, 6.5%, that's not a good deal for investor B. They got into a property without having to qualify, and it cash flows $500 a month. That's a win. Okay, so these are the benefits. Okay, so our gross profit, again, we are selling on agreement for sale. So in 3 years, this is going to close. Agreement for sale, we are selling at a $440,000 predetermined price. Okay, this price doesn't change. This is an agreement for sale. You have agreed to sell it for this price on this date, in this case, 3 years later. So they bought it for $240. Remember from the initial guy that they did the vendor take back with, they bought it for $240. They're now selling it for $440. We've got $200,000. Now we're starting to win, right? We have to not forget, though, we have our renovation and our holding costs. We did do that renovation. We did hold it for all those months while we pushed up that appreciation, right? So that cost $130,000. Profit now, 70 grand. Again, we're getting closer back into that range that we wanted to be, right? The original planned range. But bonus, remember, we're now cash flowing. So this is investor A, right? We're now cash flowing as investor A because we put a spread on the interest rate. Let me just say this is in full knowledge of investor B who bought it. We're not doing this on the sly. We're doing this full transparency. We're wanting some spread on that interest rate. Again, investor B can't get a mortgage from the bank. He doesn't care. Doesn't matter, right? This is great. I'm getting into a property. I'm getting cash flow every month. That cash flow, $350 a month over 36 months, $12,600. Add that all together, total profit is $82,600. The ROI on this, 275%. Why? Because they refinanced and pulled their money out. They also then got a $40,000 down payment from investor B. Now exponentially, they are winning hugely because all of their profits have been recouped. Okay. Does that mean that the buyer would have to qualify to purchase at 3 years? Yes. So investor B figures they can qualify in about 3 years. They're hopefully working with a good mortgage broker. Sean Impey is very good at pulling through people through that process to be able to, requalify at some point. Julie from Finance Fridays, Keith, Uthi, we have so many people that are so talented. Ray Vaza, at helping us get to that point. Yes, they would have to buy it at the end of that 3 years and qualify, right? So, wandering down these lines for a bit, there's something. Yes, right? These condos that are sitting in Vancouver, nobody is buying them. What can we do to think differently to make this a win situation? Even as kind of a middleman. Remember, investor A, this is Tyson, I'm talking to you. Investor A was solving someone's problem over here. The motivated seller solved their problem. Chico, no. Sorry, my pup is yakking at me. So motivated seller solved that problem. Perfect. Creatively. Brought in another investor, solve that problem. It's all about, again, coming back to being a good human. How can we find people's problems and solve them? It's all about that. Hey, Helen. Nice to see you. We'll see you in a little bit, I'm sure. Okay, so beautiful ending to this. They got their sale price. They're getting cash flow. They've solved a few problems along the way. Just a recap on how this deal was looking. When they figured out their contractor had not done well for them, the market had shifted in the meantime. $12,000 profit for all that time, energy, and work. Pretty frustrating. Maybe you need to take it sometimes, but again, by thinking out of the box, what can we do differently? They were able to pivot twice. The first plan was going to bring them a $60,000 benefit. Great. Second plan, even better, 82,600. So that came off of using a VTB with an AFS. You can also add in a JV and an RSP VTB in there too. There's so many strategies that we can use that we just have to know how they work and then have the tools to employ them. All right. So again, benefits to the investor B. They got an asset or a house without qualifying for a mortgage. They did have to do some fix-ups because, again, our contractor didn't do a beautiful job in making it pretty. They just did a good job in making it foundational. They were able to buy a property in an area of transformation, one where the property values were set to go up because of transportation changes. And they were getting cash flow in their pocket from day one. So pretty sweet. All of these things, guys, the buyer then also, I won't go through these numbers too much, but their investment was $40,000. Their return comes out to 43. That's 107% ROI for them over that 3-year period. So again, a win-win also for buyer or investor number 2 or investor B. All right, what can we take away from this? We have to pivot, but we don't want to panic in our pivots, okay? We want to think outside the box. We want to find creative solutions, both for those that need it and for ourselves. Yeah, restructuring debt is a huge thing that we might have to do in shifting markets, and a lot of you guys are doing that right now. And if you need help and you need contacts to do that, please reach out because there's so many people that can help, and it might take going through a few. But one thing is, you might fall 7 times, but you got to keep getting up. You can keep on falling and keep on getting up. You're going to win. The only time you don't win is when you stay down. Solve other people's problems. If you can walk around looking for people who have problems, both in the market and in just within circles of investors, if you can solve their problems, you can become this person who people go to. So who we're having on in a few weeks here, he's the guy that I would send all my trouble deals to. So I had advertising out there saying like, hey, we'll buy your house, we'll buy your house, we'll buy your house in a down market, right? When a market had shifted. And I would get phone calls. Sometimes I didn't know how to deal with them. This is the guy I would call. So he's going to come on and share some of his crazy brain, the way that his brain works. And yeah, create a spread. That's it. It's simple stuff. This is what we want to go forward with in principle. All right, guys, if you want to learn more about this kind of stuff, we do have an open house coming up for our Ignited program at the end of March. You can always just let us know if you're interested. Throw it in the chat. Let us know. This is where we learn this kind of stuff. This is where we come together and we brainstorm and we go, what the heck? How do we do this? It sounds great. It looks great. I have no idea where to begin. So it's about surrounding yourself with people. Now, before we move on from that, does anybody have any questions? I know there's probably a whole bunch of questions, and in Ignited, we will hit some of them in laser if you want. But does anybody have any questions? Sorry, what if the buyer doesn't qualify at the end of the term? Yeah, so absolutely. That's actually one of the biggest problems with AFS, with agreements for sale, is and you can do an agreement for sale. It's almost like an RTO. You can do it with somebody who lives there, right? You're just agreeing on paper to sell them this property, and you're hoping that they can qualify, which is why you want to set up whoever you're dealing with it's another investor, someone, stranger, random stranger, or a tenant of yours, doesn't matter. you want to set them up for success. Otherwise, you're going to be stuck with this property. But worst case at the end of this is you're stuck with a property that you've already pushed up in value. It could, though, be not in the best condition because it's been rented out this whole time. So are there risks to it? Do we have to stay on top of it? Would we just say, yeah, here you go, your problem now, not mine? We would not, because we definitely have stuff on the line. Okay. How you set it up, whose credit it goes, because remember, in an agreement for sale, title does not change until that 3-year mark, which means you still have your name on that mortgage. So do you want to just have them start paying the mortgage? Personally, I would not. I would want them to pay me, and I would want to be in control of making sure that mortgage is getting paid, right? Because it's in my name. Big issues have come from people who just say, okay, here, have the mortgage start coming out of your bank account. And then, down the road, they find out the mortgage hadn't been paid. So are there risks to it? Yeah, there are absolutely risks to it. Did the guy have to wait 3 more years to get his money that he'd planned to get out within a few months? Yeah. It's not maybe the perfect scenario, but it does take a bad situation and turn it into a decent situation. So doing it right and having the right paperwork, obviously, completely key. All right. Whew. This is the most you've seen Tiff working with numbers in a public setting. Yeah, yeah. This is my old stuff, and I've been really working on this in the back of my brain for a while of getting the courage to do this. And yeah, not bad. Hey, not bad. All right. Guys, if there are no more questions, then we are going to jump into laser in 15 minutes. We will talk about this more if you have more questions for our Igniteds. And for those of you that are not in Ignited, I wish you a lovely week. Next week, come back. We have Corey Lowen and Colin Graham coming back to teach us about development. So development is also a huge opportunity in Canada right now. We have not seen the likes of which since the 70s. Most of our cities in Canada have been built, had a huge surcharge in the 70s. Most of them were built in the 70s. Why? Anyone know why? Throw it in the chat. Thanks, Mom. Throw it in the chat, guys. Why were houses built or not houses, why were cities built in the 70s in Canada? Oh, thanks. I'm glad. I'm waiting for your answers. There's a 20-second delay, so I'm gonna pause. And I know it's awkward silence, awkward pause, but I'm gonna wait for your answers. Why do we think we saw those housing surges? Not sure. Okay, interesting. So the reason why was because the government incentive programs, they needed housing. They were in a housing crisis just like we are right now. Actually, not even as bad as we are right now. Boomers' kids, right? There's like this generational growth, that funnel, the population explosion. They needed houses back then and had a shortage. We need housing now and have a shortage. So the government has to do something. The banks have to do something. They incentivize the banks. They add money. They throw money into infrastructure and into programs that then leak down to developers and homeowners. All of this stuff. Remember the co-op days where they would, help you with a mortgage? All of those things is what built our cities. All of those things is what we're seeing now. Financing has never been so beautiful and so incentivized, with some loopholes, with some traps, where you can fall into. But I can't remember the word I'm looking for. But Corey and Colin are going to come in and talk to us about being small-time developers. What do you need to look for? And this goes cross-market, guys. It's not market dependent. What do you need to look for when you're developing? And what should you plan for? What are the pitfalls? Pitfall, that's the word. So yeah, they're on next week. So please come back, join us, support them. They're going to be opening up a whole treasure trove of information. All right, I'm going to let you go, guys. And Igniters, we will see you over in 10 minutes. I'm going to get off screen for 10 minutes, and we'll see you over in 10 minutes in Ignited. And cheers, everybody. Have a beautiful week.